Joining me is Tavi Costa, portfolio manager at Crescat Capital. Now, Tavi, I wanted to talk about Credit Suisse, but first let me get your quick reactions on the developing story of First Republic Bank. Any thoughts there?
Well, it's a bank that is related to the San Francisco region, so it's certainly impacted in a way through what's happening with the SVB Bank and so forth. But the most important side of the story is that the government has decided to really inject liquidity into those issues of the regional banks. And now we have JP Morgan, Morgan Stanley trying to step in as well, which are essentially JP Morgan is almost like a government bank, really. But it's in a way, it's what we're seeing is that the liquidity side of it is not so much of a problem. But it's the question really is if the injection of liquidity coming into those banks, how are we doing those injections in a way? It's either coming from the government or from the Federal Reserve, and all of those should have unintended consequences in the economy somehow. The government is running out of cash in terms of their cash balance right now in the Treasury. The Federal Reserve is doing something very different, which has been really tighten up liquidity by raising interest rates and doing quantitative tightening as well, which is allowing those assets in their balance sheet to mature. And so the combination of those things is having an impact on how the government or the Federal Reserve will be dealing with the liquidity problem. Sounds to me like liquidity, again, won't be so much of the problem. It's not as systemic as a lot of people are painting. And I think we tend to fight the last war of the 2008 by seeing of what happened during those times and extrapolating that that's going to happen again today. But I think this is quite different, especially from the government intervention side of things, where they certainly have that part of it covered. On the other hand, you have, again, those consequences, which are, in my view, related to, in a way, injecting liquidity in an economy that perhaps shouldn't be receiving that level of injection of liquidity. And how that process will get through the economy is another question that I think investors should be having as a higher relevant topic.
So on the side of investors, how does the injection impact them?
Well, there's a lot of questions about all this, because if we're going to see the cash balance situation continue to be drawn over time, which right now I think that the government has about $250 billion in cash. And then, in order the government works just like another company where they have revenues from taxes, and also they spend capital through their usual social programs. And what you have here is the government has been running a deficit for a long time. It's no secret. So in order to raise capital, they have really one way, which is issuing treasuries in order to raise liquidity. And so in order to, again, fix the liquidity problem from the banks. So what you're going to probably see is an issuance of treasuries, which right now we're not allowed to do that with the debt ceiling problem, which I think will get resolved. But when you issue treasuries, it creates a dynamic of increasing the supply of that instrument itself. And we know that the demand for it is not as strong as used to be in prior years. So it would create, again, a dynamic of pressuring interest rates to rise on the long end or the short end. It depends on how they're going to issue those treasuries. They can issue them in different durations. So I'm speaking out of terms because I don't know what's going to happen. I'm just questioning, well, how this whole process will play out. The other way around this is the Federal Reserve stepping in, which we know they have really unlimited amounts of resources when it comes to liquidity, but liquidity create unintended consequences, like I said before, which has to do with an secular inflationary environment that we're living in today that doesn't allow the Fed to really take financial conditions back to levels that we saw in prior decades. So financial conditions are likely to be tighter than we've seen in prior decades. And so for investors, what they need to think about is what would the level of interest rates that they have currently will start creating some issues. We're going to see some more bankruptcies. We're likely to see more delinquencies across consumers, and so all those issues are going to emerge if interest rates and financial conditions stay just as high as they are currently. So the question of, will the Fed raise rates by 50 basis points, 25 basis points? Will they not raise rates? Will they cut rates by 20? It doesn't matter. At these levels where we are, it's already strict enough that would certainly create issues that are, in my view, very problematic. But, I think that the bank situation is sort of hiding a bigger problem in the economy, which has to do with the way we approach markets and the way we approach financial assets because of what we had in the last 10 years. But that's a separate discussion, but it has to do with how assets are being valued in a world where we're going to see, again, high growth and low cost of capital, when really I don't think that's going to be the case for the next 10 years. And so financial conditions likely to be tighter, cost of capital probably going to be higher than historical decades and average for those prior 10 years. And if that's going to be the case, things got to be reflected in some of those financial assets that today are very expensive.
Right, and First Republic is a U.S. bank, but let me ask you about an international bank that's in the news right now as well, Credit Suisse. Help me understand the situation a little better. Is there as much of an impact in the U.S., or do you see any contagion effects? What are the contagion effects?
The contagion effect is that a lot of people are seeing this as the potential for another '08 situation where you have a total banking crisis, complete loss of confidence in the banking institutions, similar to what we saw back in '08. But the playbook is very unlikely to play that way. So I actually disagree with the negativism that we're seeing, the very much of the pessimism across the banking industries, because I don't think they're really the source of the problem here, as much as I see on mega cap companies, insane valuations that we have, or corporate bonds with credit spreads being so narrow, or even private equity businesses, when you're rewriting assets like we saw with the banks issue, which was caused by most of the held to maturity assets being depreciated in value significantly and having to be written down. Imagine if that happens with private equity businesses across most of those technology startups that are likely to be written down significantly lower. And what would that do to those businesses in general? That's a much bigger question to me than regional banks that actually historically tend to fail usually. We just haven't seen that because, again, cost of capital has been so low, and this cheap, money policies that we've had over the last years certainly had an impact on that too. So I'm not as concerned about all those situations regarding either international or more domestic. I think internationally, sure, in parts of Europe, I think that there's some bigger problems regarding the banking industries. But in the U.S., I'm not sure that's really the case. And so I am not saying we're out of the woods in terms of the problems that we have. I mean, what I do for a living is, fortunately or unfortunately, is to think about risk all day long. And so obviously I'm always thinking about what's ahead and what's the next thing that could be on the news. And to me, there are much bigger issues than regional banks in the U.S. economy that I can point out to that I don't think people are really giving relevance to those other more higher risk that poses to the overall structure of the economy.
Sure. You make some great points, but I also want to get your thoughts on, a lot of banks, including U.S. banks, have exposure to Credit Suisse, either directly or indirectly. What are your thoughts there? Is there no concern?
Well, it could potentially be a concern. And then what happens next is the question, it's a bigger question, is an injection of liquidity, right? I mean, central banks can always fulfill that liquidity issue, a liquidity gap, if we do have one, any moment. So it's not like we're going to completely have a pocket of liquidity issue where it creates everything to implode in a large way like we saw in the global financial crisis. The bigger risk to the economy is the fact that they might inject liquidity because of those problems. And the injection of liquidity does have consequences in the economy that I think people were not, again, given relevance to that process, not the other way around. So the banking issue would be resolved. I mean, the depositors got bailed out essentially, right? The shareholders of those companies, sure, they had some issues. It was a relatively small company, though. It's hard to think about that becoming systemic. But the bigger question is if the Fed or other central banks are willing to step in when you have a liquidity gap, then there's no liquidity crisis, is there? I think that the bigger crisis is the excess of liquidity, given the fact that central banks are willing to bail out failing institutions over time. And the consequences of that is, well, likely we have secular inflationary trends developing in the economy. While they may be accelerating and decelerating at times, we do have wages and salaries growth. We do have a chronic underinvestments in natural resources. We do have reckless amounts of fiscal spending, which are related to fixing issues like the regional banks and peak inequality and investing in infrastructure to reduce reliability with China or other economies. And then you have a deglobalization trends happening all at once as well. So those, to me, pose a bigger risk with the excess of liquidity now entering the market because of those issues with regional banks. And so, to me, that's a much bigger question that will have much bigger ramifications as well in other parts of financial markets.
And Tavi, let me get your view on what the Fed is going to do. With everything that we're seeing right now, do you think the Fed will continue with its rate hikes at maybe 25 basis points, or is it going to pause and not hike at all?
I don't think the Fed, I don't really have a strong view about what the Fed is likely to do as far as the next meeting. If you put a gun to my head, I would say 25 basis points will likely be the outcome, okay? Now, do I think that matters that much? I mean, I'm not sure. I think that the Fed is probably having one of its hardest jobs they've had in history. And that is because financial conditions are having, or monetary conditions, which they have somewhat control over, are in a way having two opposing forces in the markets versus the economy. So if you think about where monetary conditions are relative to financial assets being at these valuations, it's a very tough environment for investors because interest rates where they are, you're starting to see things break. And so bankruptcies are likely to start rising, delinquencies and so forth, just where interest rates are. It doesn't matter if they raise rates or not, if they cut rates by 25 basis points. It's because when you are at this range of 4% interest rates to 6% interest rates with an economy that is as levered as the US, you're probably going to have some issues. And so, but the second side of this is that monetary conditions are just not tight enough if the inflationary forces that we have developing in the economy are actually secular, which again, my opinion is that they are. Some people think that they're more cyclical. I think they're very structural. And if that's the case, then you don't want to have interest rates at the levels where they are. You want to have interest rates much higher. But obviously, you can't have interest rates much higher, otherwise everything is going to break. So yes, the Fed is trapped at the end of the day. And it's why I think tangible assets are going to perform better than financial assets, because the Fed is going to have to ultimately go back to a financially repressed environment. Every time things break, they're going to have to step back. And as they step back, inflationary forces and the need for especially investors to diversify their portfolio and look for other alternatives that are likely in the commodity space and other businesses related to those are probably going to increase again. And so you're going to see outflows from technology businesses and others coming into places like we haven't seen that have been really out of favor over the last decades. So to me, that's the real, what we call the great rotation happening, is likely to continue, I guess, to unfold as we see those things developing.
And let me just quickly ask you a crystal ball question. I don't know, you might have some thoughts on it. What do you think the next thing is to break?
I think there is a lot of potentials. I would put three pockets of issues that I find in the markets today. One is the private equity funds. I think that they've been lining up to buy SVB assets, but this reminds me of the FTX, company when right before we're really bailing out a lot of the crypto failing businesses before their own fallout. And I am not saying it's the same situation as FTX with the private equity industry, but I do think there's some major issues in that part of the economy, which has to do with where valuation of most of their balance sheet assets are currently. And I think there's a lot of write-downs to still happen. And the risk of investors just saying enough is enough, I want to get my money out, and those outflows creating even further problems in that part of the economy. Secondly, I would say that the corporate bond market looks really fragile as well. We haven't seen the corporate bond market really go through an inflationary or higher cost of capital period. The corporate bond market really goes back to the late 80s and the early 90s when there was a disinflationary environment, completely different than what we have currently. And so to me, that with much higher leverage and most corporations now facing a lot of pressure for margins to be squeezed and contract over time, and the risk for earnings recessions as well, it's hard to believe that you're not going to see corporate spreads blowing out significantly, which means that corporate bonds have a lot of downside to go. And number three is one part of the economy that is now perceived as no risk, which is mega cap stocks. To me, mega cap stocks are one of the riskiest parts of the markets because they're considered one of the best definitions of long duration assets. In general, most of those companies are at least expected by most analysts to be in business in 20 years from now. So most of the analysts that will cover those names are conditioned to also think that they will have the same level of growth that they had in the last 10 years. So they tend to extrapolate those and have crazy discount rates in order to come up with reasons for why those companies are so cheap today. And it might be quite the opposite. We might not see them growing as anywhere close to what we saw in the last decade. And they might have some major readjustments in prices relative to their fundamentals. So to me, those are some of the risks in the markets right now.
Tavi Costa, always a pleasure having you on.
Thanks for having me.